Good afternoon. Thanks for joining us for our panel in mining this afternoon. So we're looking at some of the key challenges and opportunities that mining companies are facing in 2020. And we have four panelists with us today. Ken Hughes, the COO of Microbix Biosystem. He's an infectious disease expert. Deborah Rosati, who is founder and CEO of Women Get On Board, which is an organization advancing diversity on the board. And then we have Rob Staley, who's a senior partner at Bennett Jones, who specializes in shareholder activism, and Mila Craig, founder and president of Milani and ESG consulting business. So thank you all for joining us. How we're going to run the process is we will go through each panelist and they'll kind of give you an intro on what they're talking about in terms of how their specialization applies to mining and some tips and advice for their area of expertise. And then you can punch in questions to the Q&A panel along the bottom. And as each panelist goes through at the end, we'll do a quick Q&A with them before moving on to the next panelist. If anyone has any general questions, feel free to type them in the box as well. And we'll start with Ken Hughes, who's going to talk to us a little bit about controlling infectious disease at the mine site. And I guess this really has application to any work environment. So Ken, I'll let you take it from there.
Thanks, Deb, and greetings everyone. I was asked indeed to talk a little bit about how to keep a workplace safe for staff as we move forward, and I'll get into that. Before I get started, I guess I should tell you a little bit about myself and the company I work for, just very briefly. I am a molecular biologist by training. I have a doctorate in biochemistry, but for the last several years, I've been working as a virologist in a company that is a developer of solutions to help the accuracy of infectious disease diagnostic testing. I'm actually the CEO of that company. It's called Microbix Biosystems. And as such, I'm responsible for implementation of policy, including health and safety at the company. Of course, it's somewhat ironic being the COO of a virology company that I'm putting together policies for staff safety around a viral pandemic, which is, of course, is sweeping the world, including Canada. Now, I know you guys are involved in the mining industry, and what I'll talk about is germane to most industries. But there's no monopoly on wisdom, so I thought I'd take a little bit of counsel from a different industry. And so I spoke to my brother and asked him about this, because he's the director of health and safety at a major electronics manufacturing firm in the UK. Interestingly, and perhaps not surprisingly, our strategies were completely aligned. And I'll talk a little bit about the mutual considerations we had in terms of health and safety, and some of the actual activities we do at Microbix for you to consider and perhaps consider implementing at your own shop. As you'd expect, personal distancing or social distancing, as it's been described, is the #1 health protection measure you can implement anywhere, be it the workplace or generally out and about shopping and so on and so forth. At Microbix, all staff are informed wherever possible and where practicable to maintain a distance of at least 2 meters from everyone else that they're coming into contact with. There are certain places, of course, where this is impossible, airlocks, doorways, things along those lines. And in that case, we have implemented rules where only one person can occupy that space in any given time. Where possible, people are encouraged to work at home. I work at home as much as possible, of course, but of course you can't always do that. So wherever possible, practicing social distancing is the #1 thing you can do in our view. Now, this has been presented many times in excellent publications from the Government of Ontario and the federal government. Social distancing and personal distancing, if you prefer, and hand washing, thorough and complete and not touching your face, are in fact the top activities you can encourage to protect yourself at the workplace. On top of this, at Microbix, we've implemented 2 entirely separate shifts to keep people apart as much as possible for business continuity in case there's an outbreak in one of the teams. Of course, by proper personal distancing and hand washing, we hope this does not be a necessary consideration going forward, and the 2 teams will continue to drive our business forward. But obviously, we're managing risk in this particular circumstance. When someone has a suspected illness or is suspected to have come into contact with someone with COVID-19 or whether one of their family's members might have. We implement a 14-day isolation policy, a stay-at-home policy, as mandated by the government, and we will continue to do that. As you likely know, COVID-19 is a respiratory virus which is usually transmitted through droplets generated by coughing or sneezing. What you might not know is droplets are also generated by speaking, normal speaking. Therefore, we encourage people as much as possible to do diligent personal distancing and not speak directly face-to-face to each other as much as possible. You know, text each other, do Zoom meetings, this is pretty good, and things of that nature, and of course work at home. Not speaking directly to each other is extremely important to not generating the droplets which will transfer disease. We encourage people to minimize that activity. Okay, so now some specific thoughts on what we do at Microbics, and they look like what's very much recommended by the government. We provide clean hand washing facilities and encourage frequent and thorough hand washing. We offer alcohol-based sanitizers everywhere. They're all over the place. We clean objects that are touched frequently, such as doorknobs, handles, railings, kettles, etc., with bleach solutions. We provide tissues and encourage their use, and we remind staff to not share cups, glasses, dishes, and cutlery and the like. That should be pretty self-explanatory to everyone these days. We've removed all paper magazines, so they're not shared. We check out our ventilation services are in place, and we require the cleaning of a person's workstation with alcohol and or bleach-based solutions. But you know, after all of that, the best of all is definitely social distancing, using telephone, video conference, or the internet to conduct business, or if you have to be together, working together, it's probably the case in mining, it certainly is the case in our manufacturing suites. Practice flexible hours, shifts, and personal distancing as much as possible, and then we'll keep each other safe. In practicing personal distancing, staff at Microbics are protected as best as possible. Policies we implemented actually very much reflect those that my brother told me about his electronics company, and it's the best way to go forward. I can only emphasize and recommend that you be extremely vigilant on personal distancing, implement shifts, ask people to minimize speaking to each other, and go from there. Of course, hand washing as much as possible and as thoroughly as possible with soap is the best way to stop spreading the virus. All these policies are readily implementable, and I suggest you do that. And I'll stop speaking there. Thank you very much, and take any questions.
Thanks, Ken. Does anyone have any questions for Ken? Feel free to type them in either the chat or the Q&A. Ken, since we have you and you are an expert in infectious disease, maybe you can tell us some of the stuff that Microbics is working on specifically as relates to COVID-19, because I think that's really interesting. There's been a lot of, you know, publications, and the media's really caught on to the fact that a lot of the tests that are happening for COVID-19 are somewhat inaccurate or inconsistent in their accuracy. So maybe you can give us sort of an overview on what products that are available now on the market to help deal with that.
Absolutely. So we develop a number of control products for respiratory diseases in general, and have for many years. We supply flu virus controls and things of that nature to proficiency testing organizations that make sure the testing labs are working correctly. So it was naturally in our wheelhouse to develop controls for COVID-19, and we've actually done that, and we're in the process of rolling them out and marketing them to ensure that the testing that's operating in the clinics and the labs to determine whether or not an individual patient is positive or negative for COVID-19 in fact work. There's been a lot of information in the media, quite correct, that there's problems with false positives and false negatives, meaning that, you know, if you have a false negative, that means that in a test for a patient, the patient is in fact positive and would be reintroduced into the general throng to infect other people. But also, if you have a false positive, that would mean a person who's actually healthy would be called positive and be forced to isolate. And of course, that would be very difficult in a situation where we have healthcare providers who want to be on the front line supporting patients and will be isolated based on a false positive test. So the controls we've developed are actually run at the same time as the patient specimens. They're known positives and known negatives. So if the test reveals that known positive and known negative, then we know that the tests for the patients are in fact valid and can move forward. It ensures that the test is run properly, that the reagents are working properly, and that the technician is properly trained. By doing that, we'll eliminate false positives and false negatives and ensure that resources are best dedicated going forward, and that the potential to spread this disease is in fact minimized. And we're working with provincial and federal governments to get these products rolled out to the benefit of patients and to the benefit to protect society.
And do these products work on all tests?
Yes, they do. Our particular control has the entirety of, it basically looks like the COVID virus, except it's not infectious. So it's completely safe for an operator to handle, but has all the elements that a test would be looking for, any test, no matter which provider is using it. So we basically have a universal control to ensure that all testing is accurate and decisions in the medical community are made with the best information.
And we have one question from an attendee. So what percentage bleach solution do you recommend?
It's a good question. I mean, I think 1% is fine, but I would look at the MSDS. I haven't put it together myself. It's quite dilute. We also use 70% alcohol. That's certainly a very good sanitizing agent as well.
All right. Well, thank you very much, Ken. Next up, we have Deborah Rosati. Thank you, Ken. Deborah Rosati, who is founder and CEO of an organization called Women Get On Board, which is promoting diversity in the boardroom. And thanks for joining us today, Deborah.
Thank you, Deborah. Delighted to be here.
So recently you wrote an article on your blog about board diversity, are you an agent of change? And I was surprised to learn that not that much has changed in the past 4 years. Do you want to kind of give us an update on what's going on in the boardroom and why things are not changing, in your opinion?
Thank you. It's my fight every day. So thank you, Deborah. So first of all, just background on myself. I've been serving on as an independent corporate director for almost 20 years in technology, retail, consumer, private equity, venture capital, and more recently in the cannabis sector. So I'm not coming as an expert in the mining sector, but I think there's similarities for all sectors about advancing diversity into the boardroom. So really, where we start can you hear me? Am I okay? I guess so.
Yep.
Okay, so really where we start was 2015. I founded Women Get On Board in 2015, not because the OSC brought out their complaint explain rules. It was just timing, combination of many women wanting to be advanced to boardrooms, not having the network, maybe not having necessarily the knowledge to be empowered to serve on a corporate board, maybe some encouragement. So if we take 2015 as the baseline, when the complaint explain rules came out from the Ontario Securities Commission, the data point at that time for all TSX listed companies was 12%. And the most recent disclosure practices for 2019, and there's a few good reference sources, Osler's being one of them, CSA being another, but as of 2019 proxy season, only 18.1% of the broader TSX listed companies had women on the board. So we're talking from 2015 to 2019, which is over a 5-year period. There's been, incremental change, as you can see. Some industries are doing better than others. In particular, financial service, insurance, hospitality, entertainment on the media side. But industries that are on the lower side with respect to percentage of women on the board is definitely mining, technology, and cannabis. And so I like to think about it, get asked the question, should it be the regulators that are forcing diversity quotas or targets or otherwise? And I really look at it, and if you look at what happens in other countries, so Norway as an example has quotas, and they instituted that back in 2008 for all publicly listed companies. And so they have over 40% of their publicly listed companies that have women on the board. But here in Canada, we've got a much softer approach that doesn't seem to be having impact. So I like to say that we all can be agents of change. we can all have impact and we can all make a difference. And it really starts at the tone at the top is at the board level. And if 80% of your boards are made up of men, you definitely need to extend your network. And if you don't have a network of qualified women directors, there are many resources available out there. In particular, Women Get on Board has a board shortlist service. We've worked with some of Deborah's clients on identifying a short list of candidates that have a certain qualification. And clearly these boards did not have any one woman on the board. And I would say that there needs to be other measures that companies can implement with respect to board renewal. And one of them is either putting a term limit or an age limit or both. And I've seen cases where there's been board members that have been close to 90 years old before stepping off a board, having been on the board for over 20 years. And that's really not a good governance practice. You know, anyone over 9 years to 10 years of serving on a board, from the UK perspective, independence is impaired. So I think, you know, if there was some term limits and age limits, I think you would create this renewal cycle where then when companies are looking for the skills that they need on their board and they want diversity, and there is data out there that diversity makes good business sense, it's just simply the right thing to do, then I think that's going to create more of an impetus to look outside your network and get that diversity of thought. So I would say for me, what I try to encourage is that the regulators, we're not going to wait for the regulators to mandate it, that it's a regulatory requirement. I think each company can create their own diversity and inclusion at the boardroom, and there is data out there to prove better economic performance. I know Mila is going to come on later and talk about ESG, but there was a study, there was a report that was in the Globe and Mail last week that basically said boards that have women, that have more women on their boards tend to be greener companies. And there is a study that came out from University of Calgary that basically said more women on boards have a higher threat, have higher input with respect to environmental concerns. And so there's data out to say that women tend to be a bit more practical and risk adverse when it comes to decisions at the boardroom table, and that diversity of thought is really practical, and it allows you to, even from your representation of your consumers or who your stakeholders are, if you've got a broader diversity base than at your boardroom and in your executive suite, you're going to have a diversity of thought and a different way of thinking, as opposed to having a narrowly focused. So not everybody has to come from the same industry. Not everybody has to be a CEO. You know, I have financial expertise, and I said, God forbid if the board was made up of all accountants. So you do need that diversity of thought. And I think there's a lot of different ways that companies can add diversity to your board. And I, every day, think about it. I'm in the middle of a board shortlist mandate right now with a technology company, and excited to be working with them because they know they need to add a woman to the board. And quite honestly, in 2020, I'm still surprised to this date that the conversation starts with, we need to add a woman to the board. And I'm not one about tokenism. So that woman has to have the right skills and expertise to augment. And in this complex environment that we're operating, and you have to be versed and knowledgeable in governance in your own area of expertise. If it's governance, risk management, ESG, financial, investor relations, government relations, whatever it is, there are very qualified women out there that can augment your board. I think some of the companies just need to extend their network. So for me, I think it makes good business sense, and let's not rely on the regulators. Let's all step up to be agents of change. So I think I'm going to pause on that, Deborah.
Thank you, Deborah. Do we have any questions in the audience for Deborah about ways to increase diversity, accessing networks of women? I know in the mining industry, there's, you know, part of the problem is there's not that many women in the mining industry that are qualified for board seats, but suppose there's women that have other qualifications that would be well suited to a mining board. So if I don't have any Q&A for Deborah, you can always follow up with me or her directly afterwards. And I guess we'll move on to Rob, who's a senior partner at Bennett Jones LLP, and he's got some experience in shareholder activism that he's going to talk to us about today, specifically as it relates to the mining sector. Hi, Rob.
So thank you very much. Thank you very much, Deborah. I've got a bit of a cold. I don't think it's COVID-19, but I may hack at you a little bit. I hope you forgive me for that. I will say it's after listening to Ken, I sort of wonder if you need to hear lawyers today, but we are where we are. So let me just tell you a little bit about what's going on in activism and some of the things that I'm seeing. And the topic here is how to respond to activism. And I'm currently involved with 3 activism campaigns. 2 of them are for the target company and 1 is for the dissident. 1 is in the mining sector, 2 aren't, and all were commenced before the world basically fell apart in the middle of March. Now, before I talk about handling activism, I want to talk a bit about some of the trends we're seeing and the types of activism that we see, because they require different responses. Now, Mila is going to follow me, and she's going to talk about ESG, so I'm going to mention it only briefly in the context of activism. It was, from my practice working within the activism area, it was basically not on the radar screen 3 years ago. And now we are seeing a fair bit of activism in that space, including shareholder proposals touching on a variety of issues, and also tied to say on pay, where they want to have a way to sort of get at management that doesn't do what the activist is promoting on the ESG front. In terms of the typical themes and activism campaigns, they are typically directed at promoting or opposing an M&A activity, changing the balance sheet, on operational issues or at governance issues. And I would put ESG into the sort of the category of governance issues that we're now seeing raised with some degree of regularity. Now, until, probably, 10 or 15 years ago, and it was really when Ackman came to Canada to do CP that we really first saw a wave of activism in Canada. Until that happened, the hostile takeover was the biggest threat to control of the board of a public company. But now the biggest threat is activists who take a small stake and threaten to launch a proxy fight to push for change. And they will often attempt to do what I would categorize as sort of make short-term decisions, which are designed to boost the stock price in the short term, sometimes and oftentimes at the expense of the company's long-term interests. And so there's a toehold taken, an agenda that they're promoting, something that they want to do. Often the fact that there is an activist has a positive effect on the stock price, and then getting the company to do something also has an effect. And it's a way of effectively, improving their economic position without paying a control premium to take control. And the other thing to bear in mind here is that where companies sort of make deals with activists, as they sometimes do, where they compromise and they make concessions, which often involve giving up board representation, the CEO is often a casualty of that concession a year or 2 hence, where the dissidents work from the inside to promote further change. So with sort of that as sort of the categories we've looked at, I want to talk about how to respond to activists. And I want to say that activists are typically very sophisticated. They've done it many times before, and they typically have very experienced professional advisors. And it gives them a tremendous advantage, because for many target companies, this is their first engagement with an activist. It's not something they're used to. It's out of their comfort zone, and their normal reactions to external developments don't serve them well. Many activist campaigns are designed to pressure the target into an immediate or early settlement. And you see what effectively are shock and awe campaigns, where the activists will come with an agenda. They will come with claims of shareholder support, and they will threaten you with consequences if concessions are not made to the demands that are tabled. And it's there where the advantages of the activists sort of come to the fore, because they know what they're doing, and they know how to pressure, and they know how companies typically are often respond. And many companies want to find an early solution when the activist comes to avoid a public controversy. And one of the things that I often tell them is that the early solution is often the very worst solution. And one of the things to bear in mind is that the activists who come sort of by stealth often make claims of shareholder support that are not supported by what the shareholders actually believe, and in times they're simply fictitious claims. And the biggest mistake a company can often make is to be stampeded into an early settlement based upon untested claims of support among the shareholder base that simply are an element of someone's imagination. So in terms of the typical advice that I would give to a client that's facing an activist, the first thing you would do, and this would be in our typical board memo, we would tell them that there is simply no duty to respond immediately to an activist or sometimes at all. There is no obligation to negotiate with or make concessions to an activist. And if a proposal is received from an activist, the board's duty is to evaluate it carefully in terms of the best interests of the company and its shareholders generally, and not the interests of the shareholder group or shareholder that's promoting change. Mindful that shareholder views on issues often are diverse. I see that particularly in ESG areas, but other areas as well. And some of them may not want to see concessions granted to an activist. Sometimes greasing the squeaky wheel is not what many of your shareholders would want you to do. And it is appropriate, in my view, for directors to carefully consider and evaluate strategic alternatives. And when you sort of look at a proxy contest, unless the contest is happening where they sort of jump you before an annual meeting where you should hopefully have an advance notice bylaw in place. But if it's a requisition meeting, the company has an advantage because it has flexibility to set the date of a requisition meeting, typically 5 months or so hence. And it has a lot of time to prepare. It also gets to see the proxy returns the dissident does not see, so it has an advantage in timing. It has an advantage in information. And with the advantage in information, there's the ability to make deliberate and very informed decisions about how to respond to an activist. And that often doesn't involve sort of responding immediately by saying uncle or making concessions. So in terms of how do you make an informed decision, the first thing that you would do is you would take advice. You obviously would need to get a lawyer, but we would typically suggest that depending upon the issues, you should retain a proxy advisor, proxy solicitor. They're very good at understanding your shareholder base, where the shares are held, who holds them, and how they respond. Do they respond to ISS? Do they respond to Glass Lewis? What are their issues? What do you know about them? You may, depending on the issues, want to retain a financial advisor. That's particularly if the issues raised deal with your balance sheet or potential M&A, you take advice there. But you want to sort of do your due diligence. It's critically important to talk to your shareholders. Most companies have practiced a sort of ongoing engagement with their shareholders, where they will speak with them regularly. When you are into a proxy campaign, the company cannot solicit proxies without issuing a circular first, but it can reach out to and shareholders and talk with them. It can take their temperature. It can sort of take issues or ideas coming from the activist to say, what do you think about this issue? What do you think about that issue? Without soliciting support to try to understand whether or not, notwithstanding claims by the activist, there is or is not support for certain issues, whether there is or is not support for management or for the dissident. Is there evidence the dissident has been talking to shareholders? And those are all things that can be sorted out with relatively quickly if there's a willingness to sort of take your time and engage. And we would encourage people to, divide them up, get your proxy advisor in place and go and talk to your shareholders. And the key message from my perspective is if someone comes after you, as for many companies is going to happen, is to take your time. Don't be rushed. Don't be stampeded into making immediate decisions. We know, I know I've dealt with many of the leading firms in Canada that are on the other side of these things. We know the playbook, and the playbook is not one that should intimidate you, it's one you should react to. And from our perspective, what you should be doing is trying to make strategic decisions informed by the views of your shareholders, generally in the best interest of the company, taking into account the raw vote counting that you should be doing to understand where a contested meeting is likely to end up. And like an election, if you think you're going to win the election, after you've taken the temperature of your shareholder base, you may decide that you can give the other side the Heisman, as it were, and tell them to go away. And that may be better than making a concession, giving them a board seat, and having someone on the inside who's going to agitate against the company and continue a campaign even though they won't campaign extensively against you externally. So with that, I'm going to now sort of finish this discussion by talking a little bit about COVID-19. I think we all know the world is turned upside down right now, and we're all sort of reacting to that and struggling with that. We have seen, I think sort of more so in the US in the last month, we have seen, notwithstanding COVID-19, we have seen some activism. I think we will continue to see some activism. I think the normal dynamic that fuels a lot of activism, which is I can propose this share buyback or this mechanism, issuer bid, whatever it's going to be, and we can improve the stock price. I think those dynamics are now totally out of play. The market is so wonky that I don't think we're going to see that until the market stabilizes. But I do believe that what we are going to see for the moment, at least, is there's going to be a fair bit of opportunistic activity in the capital markets. People who have cash to spend or have access to cash are going to be making opportunistic M&A decisions, and some of those will involve activism, although I suspect more of them will involve just proposals, acquisition proposals. But I do believe that, and the other area that we are going to see more of, although maybe a little bit of abated now because of COVID-19, we are going to see more activism in the ESG space. That is an area that will continue, I believe, notwithstanding the existence of COVID-19 and its effect on the capital markets. So that's sort of where I see things are at and where things are going. And thank you for all attending virtually, and I'd be happy to answer any questions anyone might have.
Thanks, Rob. Do we have any questions for Rob? I think one's just coming in here in the Q&A. So Rob, in light of COVID-19, do you expect a wave of corporate restructurings as some companies financially struggle? Do you anticipate a surge in activism where such restructurings are not seen to be fair to all parties?
I think the immediate reaction of the Bank of Canada to COVID-19 has to basically make available essentially unlimited liquidity to the banks, and the banks in turn are making liquidity available. And so I think what that is doing is that is postponing a day of reckoning and we're seeing, by the way, we're also seeing a lot of opportunistic lending right now, where people to whom obligations are owed are turning those obligations into different equity, different positions, or who are making opportunistic loans. So I think what we're seeing now is we're seeing some degree of stability that is government induced. But I expect that once, as it were, the dust settles, the underlying fundamentals of companies are going to come to the fore again, and we will see some degree of restructuring that will follow from that. But I think that's still a few months out, just given the attitude of the Bank of Canada towards making liquidity available to stabilize the economy.
Rob, due to the challenges of the small cap market in the past years, it seems like investors are moving towards a more activist approach. Is there a difference in the way small cap issues should protect themselves versus large cap?
Well, I think the large cap issuers have the benefit of the fact that they have a large market cap makes it harder for anyone other than a large player to take a position. So the number of potential creditors is limited. But I'm not sure that fundamentally the tactics are any different, which is staying in touch with your shareholder base, talking to them regularly, understanding the issues of concern to them, and staying ahead of those issues to the extent possible. I think it's a different set of predators and a broader set of predators, but I don't think that the underlying issues are any different.
Could I jump in just for a second, Deb? I just wanted to answer the question with regards to the percentage of bleach used. I said 1%, and happily I was right, but a more complete answer is we use between 0.5 and 2%. For easy clean services, it's 0.5% bleach, and we have a number of more difficult services up at 1 and 2%. Sorry to jump in there, Rob. I just wanted to make sure that the very excellent question was answered completely.
Thank you, Ken. Do you see a wave of restructuring from companies that were troubled prior to COVID-19, using the crisis as a reason to restructure on better terms than what would have been available previously? Do you think that this is something we're going to see a lot of?
I think there's going to be a wave of restructurings we have clients that have very, for example, with bond debt that are looking to restructure their bond debt because there's an opportunity to do so at a fraction of its issue price. There's just a lot of opportunities there for companies that have some ability to restructure using their own resources, and then there's a lot of it where they're at the mercy of the banks. I think from our perspective, from the law firm's perspective, there was an immediate wave of legal issues raised by what's happened in the last few weeks. And then I think there's a sense that in the second half of the year, things will be very busy on the restructuring front because the picture will become clearer and there will just be a lot to be done, either because it's internally induced or because the creditors are requiring something.
Thank you very much, Rob. I think we might have some additional questions at the end. They seem to be coming in out of order, so I might bring all the panelists back for the last few minutes just to answer whatever questions were inputted after the little session. So thank you very much, and I'd like to introduce Mila Craig, who is founder of Milani, which is an ESG consulting firm. And Mila, you recently wrote an article on COVID-19 and its connection to ESG. I think this is something you wanted to discuss with us today.
Yes, so thank you very much. Very pleased to be here. Thank you very much. So basically, I just wanted to take a few minutes and just run through a few pieces. And before I do that, maybe just explain who we are so that everybody on the call has a sense of where we're coming from in this conversation. So we are an ESG advisory firm, and probably most important is the fact that we're a combination of capital markets and communications people, which is pretty rare in this sector, actually. And some of the people on our team actually are those who are portfolio managers with well over 20 years of experience, together with sustainability and communications people. So the key is that we actually work with investors. So we've been working for a number of years, well over 10 years actually, with investors, helping them integrate ESG into their investment processes. So that's the backbone of the organization. But we also work with public issuers. And when we're doing that, we're helping them articulate and proactively communicate with their investors or their financial stakeholders on what their ESG issues are for the capital markets. We're also working with other capital markets participants like the sell side, some others that you'll see on here, helping provide training and strategy as well. And the reason I mention this is that when we are working with issuers, we are often talking to your investors. It's one of the steps that we typically take. And so in there, we have some of the most up-to-date views as to where the investor community is right now. And yes, we published this article earlier in the week, so I'm happy to share some views on both of those with you. So the first thing we always like to talk about is what do we actually mean when we talk about ESG issues? Because there does seem to be some confusion out there sometimes. Typically, it's the thought that it's the E, the environmental side. Here, what you have are some ESG issues. So obviously, the environmental, carbon footprinting, water usage, waste management. These are all things that, as a mining company, you're dealing with already. On the social side, the employee attraction and retention, diversity that Deborah brought up a few minutes ago. In your case, social acceptability of your projects tends to be one of the key ones. And then as we move over onto the governance side, compensation, corruption and bribery, climate change, which has been a topic of the markets. We expect it will continue to be, but culture is a relatively new one on this list of governance as well. And we bring it up here because in conversations with our clients right now, what we are finding out is that the governance, or the culture, really is one of the major elements of the success of these business continuity plans that a lot of our clients are dealing with right now. Being able to say, listen, the right things were in place, the risk management systems were in place, our people are up and running very quickly. These are the types of things that investors actually are watching for, and they are board issues. So one of the notes in our article this week was that the E typically is thought of as environmental. Right now, what the market is thinking most about on the E is actually your employees. And the COVID situation is really highlighting the interconnectedness between these social issues and the economic issues. And it's really, you know, how you are treating your employees in this crisis is something that is definitely being watched and assessed by your investors. In fact, there is this regroupment of responsible investment, or ESG investors, called the UN Principles of Responsible Investing. And they put out a note last week to their signatories suggesting that labor and employee relations is actually the topic in which investors should be engaging most with their investee companies right now. So on that note, we'll also say, don't assume that the environmental E goes away. It probably does short term as the focus is on employees, but there is a major trend in this market with a transition towards a low carbon economy. And as that discussion continues, we think it will be very much part of the conversation post COVID-19. And I'll talk a little bit more about that in just a second. What I wanted to show, though, are basically one of the reasons that we are bringing this forward is that ESG funds have actually done quite well in this market. What you see on the left-hand side are some of the ESG funds that have been around for the longest time. And you can see that some of those in the 5 to 10 years are actually in positive territory right now for returns. And then on the right side, what you can see is that funds are actually flowing into ESG funds right now. So it's actually quite interesting. It's one of the few places in the capital markets where funds are flowing. And this becomes really important for you as issuers for two reasons. One, asset owners, for whom asset managers run their money. It is now being proven out in the markets that these ESG funds actually are less volatile and may actually be a protector for their portfolios. And as that's the case, we expect that there will be more and more of a move of assets going into ESG funds. As well as a public issuer, that means that the capital that will be available in the market as we come out the other side of COVID-19, this market correction, that the money will clearly be focused on ESG issues. And it's interesting, Rob, to hear you make those similar comments. We believe that the mining sector actually is in a unique position in the fact that when we move towards this transition to a low carbon economy, actually, we need the metals. We need many of the metals to make this transition happen. And without the metals, it's going to be very difficult. And what that means is that there is an opportunity for your sector more than others to perhaps get access to certain levels of capital. With that, one of the key questions that comes up with respect to that is, if you're not disclosing information yourself into this marketplace around what is financially material from an ESG basis, then what's happening is third-party rating agencies are telling that story and are creating the information in the market about you. And it becomes really, really important, especially as noted by Rob, about activism and mergers and acquisitions. So this morning I saw from an institutional investor article that Boston Consulting Group did a survey of institutional investors last week. And basically the two biggest expectations from that community is, one, that there will be an increase in activism, and two, that there will be a significant increase in M&A. So not surprising. I think the one thing to remember, though, when considering activism is that it's not the same thing as shareholder engagement. And one thing about investing is, as an investor, there is actually a need to engage with your investee companies. And that's done in an effort to highlight to you potential risks that you may not be seeing or potential opportunities. So it's not necessarily meant to shake up your business, but it's often much more of an opportunity to support your business. Of note, though, is that recently we have seen, because of the activists coming into this space, that we have seen that the pricing of companies that have an activist investor does tend to go up over the 2 years following that. So we have seen an increasing trend where your shareholders are actually supporting activists when there is a proposal put forward. So it's really important to understand there is a nuance and there is a difference. So be very open to these dialogues and these engagements with your investors, because when an activist potentially comes forward, it can have a major support for your business. And last thing on this point is that there is an expectation of significant mergers and acquisitions to come out of this crisis. So the first thing is, if you're about to engage on M&A, I think you should make sure that ESG is part of your due diligence. It's where capital markets are going. You do need to make sure that you're not overpaying for assets. There could be some major liabilities. And vice versa. If you know your financially material ESG issues, you can make yourself more attractive as a target as well, and potentially garner a higher valuation. And I would suspect that your investors have done some of that work already. Both are possible, as noted, that currently money is flowing into these ESG funds to back acquisitions with values around these issues. So just back to the presentation and the note that we put out earlier this week, the question we're getting over the last 2 weeks is, do I continue to spend money on disclosure of ESG issues in this kind of market? And we believe that how you're acting now with respect to disclosure of these issues to your financial stakeholders, that being your investors, your bankers, and your credit rating agencies, that they will all be very important in how you act in this crisis, but equally how you're disclosing and how you're putting this information into the market for those stakeholders to be able to understand your stability. It was noted by Bank of America in a note that there's already obviously major downgrades in earnings scenarios. And we believe by you disclosing this information into the marketplace, that it puts you in a position to proactively change the story. And rather than allowing, again, these third-party rating agencies or the brokerage community to tell your story, it puts you in a position of power. And so what does that mean for you? So what we've laid out here is that there is a resource-efficient way to manage this. And rather than focusing on creating that 100-page sustainability or CSR report, that you can really focus on creating an ESG report. And there is a difference between them. So an ESG report tends to focus more on those financial stakeholders, as mentioned, your investors, your banks, your credit agencies. They're focused on your financially material ESG issues. So they're typically somewhere between 5 and 8, whereas the sustainability report is much more multi-stakeholder, driven by stories and photos, and versus an approach that is very much about focusing on your financial viability. An ESG report will also have metrics and targets, and we try to match them as relevant to your business, because each sector and each business is different, but we match those to frameworks that the investor community is using so that we can start to have this comparability. And one of the biggest issues in the market right now for investors is actually getting quality data. So we've seen that shift at the second half of 2019, where investors were moving away from using third-party rating agencies and screening, et cetera, to really using data and doing their own work. So the more you're able to provide them with appropriate data of your own that they can score and use in their modeling, it really puts you at an advantage versus others in the market. So ultimately, we're hearing a lot of noise behind the scenes or sustainable finance being the way out of this crisis, because that's where the capital is, and that's where we begin from. So if you believe that you're going to need capital to survive or recover from this COVID-19 crisis, being able to articulate and communicate to the financial community those financially material ESG issues, it becomes a must. We have multiple methods for doing that, depending on organizations at their size. You know, we've got a cohort program where we could take 5 to 8 companies together at the same time, a full-fledged, or we actually have a more condensed version for one-on-one basis as well. So I think I'll leave it at that, Deborah, and be happy to take any questions.
Thank you very much, Mila. I do have a number of questions coming in. First, how important is the storytelling aspect of ESG, and what are the best ways to do so during this sensitive time?
Well, I think the most important thing is it's less and less about it's actually less and less about the storytelling, and it becomes more and more about metrics and targets. And the first step is really knowing your issues. Once you know the issues, it's really then about getting the right information around specific metrics on those issues into the marketplace. And so we've been helping a lot of our companies reduce the substantial down to, it can be as small as 8-10 pages now. So really what you're trying to do is take more and more of the story away and really provide really fundamental information about those issues and why it's important to your financial viability, and then providing background information and data.
I've got another question from the attendees. What are the risks of losing many Canadian companies post-crisis via aggressive M&A by foreigners driven by low valuation and weak Canadian dollar? And what role should governments and our large institutional investors play?
So, I mean, I think there is a big risk. You know, I think it's a huge part of our economy. We've had a double whammy, right? With the energy plus the COVID. So we do have a large part of our Canadian economy that is under stress right now. In our world, in the ESG world, there is a whole conversation that's taking place about transition finance. We've had a new taxonomy come out from the EU that is less about green and more about possibilities of how do you trans businesses towards a lower carbon economy. And resource-based economies are going to need that. So in Canada, we have our own taxonomy that's supposed to be coming out later this year. Nordic Investment Bank come out with I forget what it was called. I think it was a recovery bond this week. And part of that call is that our public institutions should perhaps be stepping up and coming out with bonds to support the recovery for the Canadian economy. So I think there are a number of elements there. We could probably spend an hour just talking about all of those different things, but I'll open it up to let Rob respond as well.
Yeah, look, I think that there's going to be some degree of consolidation, opportunistic consolidation taking place, and it will cross international borders. To the extent that Industry Canada approval is required, I would not be surprised if that approval is harder to obtain for the foreseeable future as a potential means of dealing with opportunistic acquisitions. I think there's a fair bit of speculation now, for example, about what's going to happen to Cineplex, where that is a live issue. I do think you're going to see some of the institutions, certainly the Quebec institutions, will step up. It's not clear. So governments are putting a lot of money into a lot of things, and there may be limits on how much they can put into trying to defend Canadian domestic companies. But I wouldn't be surprised if some of the pension funds are prepared to see some investments made there as well. But I do expect there'll be some consolidation on both sides of the border. And there may be some Canadian companies with money going south of the border as well when we see this thing shake out.
Thank you, Rob, for jumping in. And I encourage all the panelists to start jumping in if any of the questions apply to them. So I have a question coming in about charity flow-through. So charity flow-through financing is now a significant source of mineral energy exploration risk capital. The format enables gifting to registered Canadian charities by individuals. Would a participating mineral resource exploration company be able to point this financing format as a positive social contribution within the ESG framework?
Ooh, that's a really good question. I'm not sure that I'm able to answer that question, and I don't know, Rob, if you have any more perspective on that, but I'm not sure that I have a particular view. I'd be happy to whoever answers the question. I'd be happy to
I
try
can
to
connect you. Yeah, it's a fairly specialized question.
Yeah, I'm not sure that I could. I mean, I think company could attempt to point to it as a form of net benefit to the community, but I'm not familiar with the frameworks enough to give you a definitive answer on that.
And then another question for Mila: how long, page-wise, should a typical ESG report be, just so we have a benchmark?
I would say, you know, it's not about the number of pages; it's about the content in the report. You know, we've helped with clients where they've narrowed it down to an 8 to 10 page report, and it's, here's my 5 issues, and you know, you give your general governance, overall governance, and then you go into each of the issues and you're providing some metrics and targets. I think investors might like more than that, but it really depends on where you are and, you know, how much you can say. But you obviously want to say as much as you can and provide the market with as much as possible, but you can also, you know, get metrics and targets towards some of these frameworks into an appendix, and the data is the most important part right now. And then the investors, I think, will be able to interact with you if they have further questions, et cetera. But I would say, you know, 20-page report is an ESG report would be pretty common. Versus a 100-page CSR or sustainability report.
Deborah, we actually have some questions about board diversity, if you want to jump back on.
I'm back on.
We do have one question for you in a little bit as well. So, Deborah, if we consider what role women are being given on boards, the 18% figure is overstating women's real participation into board strategic discussions. Investors need to do more diligent work when voting proxies and engaging with issuers. It's just a comment that I think they wanted you to speak to.
Well, make sure I understand it. I think shareholders can have a vote, and some of the large institutional investors, some of the large pension funds are actually withholding votes if there isn't diversity on the slate. And the one where they're particularly withholding votes is chairs of nominating corporate governance committees. So if a slate of candidates are coming forward for re-election and there's not a woman on the board, there will be withheld votes. And, you know, some of the large institutional investors have stated that in 2019 and 2020. So I'm not sure if that answered the question, but there is a trend that way. And I think investors are getting behind their vote with respect to diversity.
And just a comment to add there, Goldman put out that they would only bank public companies with at least one diverse board candidate. So it's starting to shift to become more of a requirement than it was in the past.
Yeah, and I think with respect to Goldman Sachs, they basically, it was their, we will not take a company public without that board has to have at least one woman. And I think there was a pushback to say, why just one woman? Shouldn't it be multiple?
And I think this is a question for both Mila and Deborah. We've seen a group of Canada's largest investors start to mandate that women need to be on boards as part of their investment criteria. Typically, this is directed towards S&P TSX listed names. Have you seen this standard trickle into the smaller cap names as well? And what trends have we seen in the smaller cap names?
Maybe Mila, because I did speak a lot on board diversity. Do you want to weigh in from your client perspective or the companies that you're working with on that question?
Sure, happy to. So yeah, I mean, I think yes, it has been the larger cap companies where the focus has been, I think, by many of the investors. However, I think, you know, we are seeing a number of investors in Canada as well, being very clear, maybe not as, maybe just not as public about their responses, but being very clear that they will be voting against nominating committee members or the board in general if there aren't. And it's, I think the other thing in Canada is that we're also moving as of January of this year under the CBCA, the Canadian Business Corporation Act. You know, companies now have to disclose the level of diversity, not just gender diversity, across their senior management and their board. So I think we're going to see a lot more scrutiny of this in Canada. whether you're large cap or small cap, it won't really matter if you're registered under the CBCA. And, I think it's a topic that has come a long way in a short period of time. The numbers still aren't very high, but I do believe that conversation, the vote is happening, and it's almost a given in the investor community that we're speaking with now, but that's changed a lot. I think 2019 was that year where the investor community really came together and just went, okay, this is done. Like we're going to now vote.
Yeah.
So that's my interpretation of what.
Well, and I say that I use the broader term agent of change. So that is an example of agent of change. It's the investors themselves that are pushing back. I think the chairs of nominating corporate governance can say, listen, when they're doing short lists, if there isn't a woman on the short list, you got to go back and go deeper, and go broader in your network, and, put some disciplines around the renewal process. Being on a board for more than 15 plus years, you really are not independent anymore. And anyone that exceeds a certain age limit, I think some of that can be honored as well.
And I think I would just throw in there, gender diversity is really important, but so is, diversity of thought. And, even in our community, increasingly, we are seeing people from the ESG space being sought after to go on boards, because there is a different thinking that comes around this conversation. If you are working in northern communities and, do you have a representation from some of the Aboriginal communities for where you have your projects? This becomes really important to investors today.
And I totally agree. Last year we had a mandate. We were working with a mining company, and they were very specific. They had Quebec properties and location, and they wanted someone out of Quebec, had to be bilingual, had to have government relations, Aboriginal relations. Like, it was very, very defined. And that really was speaking to that broader diversity of thought.
Yes.
Well, I think we had one more question for Ken, if he's still around. There you are. Hi, Ken.
Sure am.
So somebody was asking what they should do if an employee starts to show symptoms of COVID-19 or a cold or whatever, like what the protocol should be. Do you just send them home, or do you shut things down? Do you isolate other people on the shift? What would be best practices?
Well, best practices are to adapt what the government regulations are. What we do at Microbics in that particular situation is, if somebody's clearly ill and there may be some COVID-19 component to that we send them home for 14 days for self-isolation. One of the reasons we had
to do anything with anyone else that they've come into contact with? Sorry.
We've had some discussions, and one particular individual who was put on isolation for 14 days, whose mother, who she lived with, had been potentially in contact with someone with COVID-19. So it was one of those things for super safety. In terms of, general, if you have a sniffle, because, obviously this is the cold season, and, 99 times out of 100, these types of situations right now, at least, will just be a cold, and we send people home for at least 48 hours post when they're feeling better. Then we have an interview with them, but the general default position is a 14-day isolation, yes.
Okay, great. And I think that's it. One person's just asking, in terms of follow-up, if it would be possible to share some of the panelists' information if some of our attendees wanted to discuss further with them. I'm sure that's fine with the group.
Absolutely.
And I'll just get Everett to come back on, so I can thank
absolutely, no problem.
For being my panel guinea pigs on a Friday afternoon. So thank you all for participating. I will try to make the video available if it is edited well. Sometimes these look good and sometimes they don't look so good. So fingers crossed that this one turns out really well. And I appreciate all of you spending some time with us and explaining to our audience some of the like finer points about things that are changing for the current mining practices and some areas that a lot of executives need some help. So I appreciate that. Thank you.
Thanks.
Thank you.
Have a healthy and happy weekend.
Be safe, everyone.
You too. Bye.